The biggest benefits from tokenization don't come from creating liquidity per se.
So to some degree, you know what's coming.
Yeah, it's a really sticky point.
I'm going to go out on a limb and say I'm not sure that's going to go well.
Yeah, have all of your financial assets just on your wallet. And in a single click, you can move from platform to platform. There's no lock-in.
Are these competitors or are they future partners for an Ondo?
Both, right? There's always an element of both, I think.
The tokenization of real-world assets is arguably the best use case for crypto moving forward. It's certainly one of the ones that's getting the most attention. And one of the companies that's at the forefront of tokenizing real-world assets is Ondo Finance, with partnerships like BlackRock, Goldman Sachs, and Franklin Templeton. They are driving institutional adoption of this technology, so nobody understands what's coming for the industry better than Nathan Allman, their CEO and founder. There's an incredible conversation on the future of crypto with an incredible, incredible mind.
That's dope.
Tokenization of real-world assets has been one of the biggest narratives in the crypto world over the past few months and even years. You're at the forefront of it. Let's just start from the very beginning. What does that actually mean? How does that actually work?
Yeah, thanks, Scott. It's great to be here. So tokenization is the representation of off-chain assets on a blockchain. You know, Bitcoin was really the first digitally scarce asset that could be held by anyone, anywhere, at any time, and, you know, transacted on a peer-to-peer basis without any intermediaries, and allowed for very low friction storage and transfer of wealth. You know, that concept has been replicated many times in crypto. You know, there's, I don't know, hundreds of thousands or, you know, millions of different tokens that are out there. And what we're trying to do is take a lot of the benefits of that technology, the low friction transferability, the global access, and apply it to so-called real world assets. So stocks, bonds, you know, ETFs, traditional financial assets. Tokenization broadly, you know, could refer to art, collectibles, you know, really anything that, you know, is not natively generated on a blockchain.
I think we saw the first iteration of this with the NFT craze, although that went in a wildly different direction than maybe the tokenization maximalists would have expected, with, you know, Bored Apes and cartoons and 10,000 PFP collections. But at the core, an NFT was effectively what we're talking about, correct?
Well, I guess there's fungible and non-fungible asset tokenization. You know, NFTs, of course, by their name, were non-fungible assets, and everything that we do at Ondo is tokenizing fungible assets. So certainly a core distinction there. I guess NFTs were, in most cases, also generated specifically for distribution on a blockchain. Like, they weren't assets like financial assets that are also sold in markets off of a blockchain. So I guess they're a little bit of a hybrid there. Like, I would agree that that's probably a type of tokenization, but, you know, wouldn't fall under the category of so-called real-world asset tokenization, which is the space that Ondo plays in.
Right. In the initial days of NFTs, though, the things that people got excited about were not the cartoons. It was about my car title could be an NFT and I could transfer it from myself to another person, or my mortgage, given we never really saw that play out. Or, you know, tokenizing a house. We saw that happen, right? With an NFT, and I transfer the NFT and therefore the ownership of the house. Novel, but it didn't really get there.
Yeah. And really, this is an example of a much broader thesis that many folks in the industry had for, you know, quite many years, which is that because tokens can be transferred so cheaply, quickly, securely, that by tokenizing assets that traditionally settle or transfer, you know, on slow cadence with high cost, that we can make those assets, you know, more liquid and more easily transferable. And it's a fairly naive thesis because it fails to look at all of the reasons why these assets, like real estate, are illiquid. Technology might be one of the factors, but there's also challenges around how do you price these bespoke assets. There's regulatory challenges. Often issuers or asset owners don't want these assets to become liquid. So there's a lot of barriers other than tech, which it turns out is not really the limiting factor. The tokenizing individual homes and making them super liquid, was sort of always particularly destined to fail. And, securitization, bundling these assets of similar types, slicing them out into tranches with different risk levels, that's the TradFi way of, creating fungibility amongst non-fungible assets so that more liquid markets can form. I think that works really well, and we're going to see more of that on chain. We think the biggest benefits from tokenization, don't come from creating liquidity per se, which tokenization really doesn't do, but rather to expanding access to already very liquid tokens and to enabling on-chain programmability. So all the benefits of DeFi, again, for already liquid tokens.
Okay, so explain then Ondo's unique approach to all of this, because obviously we've seen a competition for the tokenization of real world assets. We see major institutions doing it with you and with others. We see it happening on popular L1 blockchains, but we also have built for purpose layer one blockchains like Ondo. So what are you doing that's different?
Yeah, so we started out by tokenizing one of the most liquid assets, US Treasuries, to make yield-bearing alternatives to conventional stablecoins. We call them yield coins. We have two products there. We have OUSG, which is our permissioned, US accessible treasuries fund, accessible to, qualified purchasers and accredited investors, that can be transferred between whitelisted holders. And then we also have USDY, which is our effectively permissionless yield coin. Like stablecoins, you have to be KYC to mint and redeem, but you can transfer more freely in secondary markets. Both of these products, of course, pay their holders a yield, unlike conventional stablecoins. So we started doing that in January 2023. So a little over 2 years ago was when we launched the first of those products, OUSG. There's been an explosion of tokenized treasuries and other yield coins since, easily, 50 plus to date. And as that's been happening, we've been working on, the next big shift that, we think the industry is going to see, which is tokenized public equities and ETFs. So we announced a few months ago at the Ondo Summit in New York, Ondo Global Markets, which is our platform for tokenizing public securities. So anything that you can buy today at an Interactive Brokers or a Robinhood, you'll be able to buy on chain from us. And you'll be able to do so, very importantly, with access to the same liquidity that you would have at a conventional broker dealer. We think that's really key for making sure that the tokenized representations of these securities are not any worse than the traditional representations. And I think that's table stakes to making it possible to tap into the accessibility and programmability benefits that come from tokenization. And then as part of enabling Ondo Global Markets, we've found a number of infrastructure challenges with conventional public chains, particularly when it comes to getting institutions, broker dealers especially, to participate in issuance and validation on the network. And so we are developing Ondo Chain to support Ondo Global Markets, and similar tokenization activities. It's a hybrid public permission chain. So validators are permissioned, but just about everything else about the chain is permissionless. So anyone can view transactions on the chain, deploy code, have a wallet, etc. It's really purpose-built as a hub for tokenization, to then distribute these tokens to the broader public blockchain ecosystem our assets, USDY and OUSD, are already on 8, different public blockchains and growing. And, we're very much going to continue to focus on distribution in this multi-chain manner. And, we think the world is going to be increasingly multi-chain, but Ondo Chain will play a key role in coordinating a lot of that activity when it comes to tokenized assets.
What makes Ondo Chain or any other chain that's somewhat purpose-built for a specific use case, what makes it different than using an Ethereum or a Solana or an Avalanche, something that's already been built, and why make that jump?
One important consideration, particularly for regulated securities markets, is not having front running and other forms of malicious MEV. These are particularly problematic from a regulatory perspective. I mean, broker dealers have a responsibility to not front run their clients' transactions and, provide so-called best execution. So, by permissioning the validator set, that's something that we can pretty easily effectively guarantee, while we think not really giving up that much commercially, given that everything else is still permissionless. And then also just from a regulatory perspective, not paying transaction fees to unknown validators, which can cause, AML and other issues there. But, we're building a Cosmos chain, which is very flexible in what it lets you do. So just as an example of something that we're pretty excited about is coordination of cross-chain governance. So we will have contracts on Ethereum and, a whole bunch of other public blockchains that support instant minting and redemption of our global markets tokens. But there's risk parameters, mint limits, et cetera, that have to be governed on all these different blockchains. And the way that we're going to coordinate that governance is through Ondo Chain. So the institutions who are participating as validators in the Ondo Chain network will actually be responsible for upgrading, via a governance mechanism, that we're working on with them, the parameters of the global markets infrastructure on all of these other public blockchains. So part of bringing Ondo Chain into existence is a response to some of these challenges that public blockchains have for our use case. And then part of it is just, wanting a new hub for coordinating the activities for the infrastructure that we are building on all these chains.
I mean, when you look at your site, you have BlackRock and Goldman Sachs, obviously scrolling across the bottom, Franklin Templeton. These are the biggest financial institutions on the planet that you're working with in some capacity already. Are you saying that those kind of institutions will actually be the validators on the chain?
Yeah, that's right. I mean, I can't say specifically who yet, but many of the world's largest asset managers, some of which have already issued tokenized treasuries funds. I mean, you can look at Franklin Templeton as an example. They're already a validator on quite a lot of public blockchains. I think they've really been at the forefront of, that particular activity. And a lot of the other of the world's largest asset managers are, going to be pretty quick to follow suit there. So, it's been really exciting to see the very sudden interest, particularly from asset managers, and now increasingly from broker dealers and banks, post some of the changes in the new admin in tokenization.
So to some degree, you know what's coming, or you get a glimpse into the future because you're talking to these institutions, you're building things that are obviously for the future and not for just the needs now. We have tokenized treasuries across the board, as you've said, right? And a lot of protocols are doing that. I would say that that's a proof of concept, as are stablecoins as a use case. What are the sort of next things you think that could break this open to a much wider audience? What assets, because we have, it feels like infinite assets that could theoretically be tokenized, doesn't mean it's all a good idea, right? So what is coming next, would you say, that you're excited about?
Honestly, the conversation with asset managers in particular is still pretty dominated around treasury funds, where
they want yield.
Just barely scratch the surface. And, the prevalence of stablecoins in, traditional financial discussions and, the stablecoin legislation that's coming and, debates around whether there can and can't be yield there. I mean, I think that's really created a lot of focus around How do institutions make cash funds more usable in an institutional context? Because they're still really only used by crypto natives, particularly high net worth individuals, startups, foundations for treasury management purposes, by crypto traders as collateral. But the use case is still very, very narrow. So there's a lot of discussions around how do we use these sorts of products for international settlement, for collateral in, more institutional trading contexts. Like the CFTC, is recommending approving it for, use in certain derivatives, transactions. That's the overwhelming focus right now. Like, we are guiding a lot of the conversations towards public equities, particularly in the context of participating, as service providers in global markets and Ondo Chain. And I will say it has been infinitely easier, truly, to get broker dealers and banks to work with us as service providers for global markets than it was when we were trying to launch OUSG in the first place.
That's interesting. Is that just a matter of the evolution of the regulatory outlook and just it not being viewed as only for criminals and criminal activity now, the maturing of the asset class to some degree?
Yeah. I mean, 2 years, or I guess it was 2.5 years ago, just FTX. So many of these broker dealers and banks had blanket policies to not work, with folks in digital assets. And it's just a total 180. Not only are they able to work with folks in digital assets, but it's like a strategic priority, and they're throwing tons of resources, at us and like competing to, want to be a part of it. So, it's very exciting to see. I mean, even that's a big shift from a year ago. Like, there was interest from a lot of asset managers then, particularly FOMOing in after, the BlackRock Treasuries Fund, and tons of them, put in and still have their own treasury funds in the works. But the interest from the banks and broker dealers is much more recent. I think the repeal of SAD 121, is certainly part of that, but obviously,
I was going to float the not so tinfoil hat at this point theory that maybe they were still interested a year or two ago. The Fed and the FDIC and OCC were just telling them they couldn't. Right? I mean, Operation Choke Point 2.0 is not a myth. We've now seen it pretty handily proven across the board. And you even have the Fed chairman, Jerome Powell, speaking on it, right, and saying that banks should participate in crypto activities. I'm looking into all the ways that we were blocking that in the past. There's no mystery that they just couldn't. So I would say that, in my opinion, that's largely administrative change or just policy shift with a new administration that's opening the floodgates to a lot of people who probably wanted to do it and literally just couldn't.
Yeah, absolutely. And I think the attitude the new SEC has been taking has been, very constructive as well, towards encouraging these institutions to support things like tokenization.
So for an institution who can easily access United States treasuries from the United States Treasury, right, and can take short duration bonds or, and easily get in and out of them, what's the advantage for them of tokenizing that exact same asset for a comparable yield?
Distribution, really, right? I mean, for now, institutions are after distribution to a global, somewhat more retail leaning, certainly for now, crypto native audience. I mean, capital markets are still extremely fragmented. Just about every country has its own, securities depository system. Cross-border security settlement is extremely slow. Access to US financial markets is, very cumbersome. I mean, accessing like margin outside the US for retail at, remotely reasonable rates is very challenging. Through things like Ondo Global Markets, we can provide global retail investors with a much better way to access US financial markets. And ultimately, like, that's more distribution, that's more fees at the end of the day for broker dealers, custody banks, asset managers. I mean, they're still playing all their conventional roles
Yeah, it's not because they want to hold the treasury. It's because this is a way for them to expand their customer base and utilize those in more novel manners, right? And so even participating in DeFi or, as you said, opening to customers all around the world. I don't think people realize that if you're not in the United States, it's really difficult to even buy stock, right? I mean, it's not that easy to buy Tesla stock if you live in most places in the world.
Yeah, that's right. I mean, I think there's like a couple of phases here, right? I mean, phase one is the institutions. I mean, banks, broker dealers, custodians, at least, they do just want to hold the assets and earn fees from doing so, and broker the buying and selling from an audience that itself is using DeFi,
Right.
and they're not using DeFi yet, but then they're also looking at DeFi, and we're still in the like pilot phase of what some call institutional DeFi, using smart contracts for more traditional regulated financial activities. And I'd say we're still in like relatively early days of that, and that's going to take a good bit more time.
Right. They can make money on customers outside the United States they probably couldn't make money on before. For now, that is an exceptional use case for them. It's interesting that you have USDY, which is obviously a yield-bearing stablecoin that can be used in DeFi, right? As you described it, like any other stablecoin. Of course, not available in the US still. And we now have this push and pull with stablecoin regulation on yield-bearing stablecoins. Actually, it seems like there's consensus that stablecoins need to be regulated, that we need sensible regulation, that people should be allowed to use them. But the one sticking point that the industry actually really wants, Brian Armstrong, notably maybe the loudest voice, is that these should be yield-bearing instruments. And largely the legislators are pushing back and saying they should not.
Yeah, it's a really sticky point. We created USDY in part given the regulatory uncertainty around stablecoins. USDY is very clearly able to pay yield because, at least from a US securities law perspective, it is structured as a security, right? It's a tokenized note that is secured by, backed by US treasuries with an interest rate that is set by the issuer on a monthly basis. So we think from the perspective of USDY, whatever happens within reason, on the stablecoin legislation, we think doesn't really impact our ability to pay a yield, but it certainly will be interesting to see where things shake out there. I think there's reasonable arguments to make to say that, stablecoins potentially ought not to be paying yield, or at least that ought not to be where we start from, while, we can have equivalent products that are, under the remit of securities laws that can pay yield. Just like, money market funds and all sorts of equivalent securities, compete with, low yielding deposit at a bank account, but pay yield and are fully backed by treasuries.
I mean, I guess it does make sense that a stable coin right now, nobody wants it to be deemed a security. And the minute that you add yield, it likely is. So I think
it certainly looks a lot more like a money market fund. And part of that is because, banking regulators have not approved narrow banks historically, right? So this idea of an institution that's like only holding treasuries or only parking cash in like a Fed master account and issuing liabilities, like if it's regulated as a bank, it's a so-called narrow bank. And there's been all of these historical applications, pre-blockchain to get them approved. One literally called the narrow bank, which, the Fed denied its application, I think, for a Fed master account, in part on the grounds that it was viewed as being too risky or too potentially disruptive to conventional commercial banks, which the economy relies on, increasingly less, but still to some degree for commercial lending activities. And I think part of the argument is that, like, well, if you really want this exposure, you can just go get it in a treasury's money market fund. And it's maybe not quite the convenience of narrow bank, which has, sort of unlimited intraday wires in and out, et cetera, but it's very, very close. It's interesting, though, in the context of tokenization, there isn't really any convenience difference between a yield-bearing stablecoin that is presumably regulated as, a banking-like instrument and something like USDY, which is, I'll call it a yield coin, that is more regulated under the securities law umbrella, right? I mean, when you're transferring a token, like it doesn't really matter how it's regulated because settlement is all happening on the same rails.
Right. So I guess what's interesting, and this is the question with everything in crypto where there's yield, is that there's fear that the yield is somewhat being, orchestrated in the background in a way that people don't understand, like we saw in all the CeFi collapses of the past. You would think that a yield-bearing stablecoin that's simply taking the model that the company issuing that stablecoin is already using to make money and just passing on some of that yield to the customers and taking less profit themselves would be a no-brainer, right? I mean, if we all know that, Tether's making billions of dollars, for example, by simply buying short-dated treasuries and collecting that 4 to 5% yield, and that amounts to billions of dollars because of how much they have under AUM. If they were to say, hey, we'll give 2% to our customers and we keep 2%, that shouldn't be controversial to me. But I guess the yield would have to come within some very specific rails to not be clearly a security. If all of a sudden they become a fractionally reserved bank and start lending that money to earn a larger yield to pass on to their customers, I see where that becomes problematic.
Well, sort of ironically, in some ways that makes it easier for that sort of instrument to fall within banking.
Because it's fractional reserve banking.
Regulation. If they're fulfilling this banking function of lending. Look, I mean, I certainly think the product of, a stablecoin like instrument that pays yield should exist. I mean, of course I do. We've built that
one.
but I do think there is a lot of nuance in like what is the right regulatory regime, securities law, banking law, et cetera, to allow that type of product to exist in. And I do think there are complicated arguments around like the sequencing. I mean, the disruption to banking, I do think is a real concern. I mean, I'm very like anti-commercial banking in the long term. But there is, I will give some credit to that argument for now. There's also complicated tax issues when you deal with distribution of these products in the US, right? I mean, how do you need sort of reasonable systems in place to, to deal with tax compliance in the context of a yield-bearing permissionless instrument that's distributed in the United States.
The notion that narrow banks or fully backed banks should not exist is one of the biggest head scratchers I've ever seen in this country. Obviously, I'm friendly with Caitlin Long from Custodia Bank.
It is very frustrating, for sure.
Yeah, from Custodia Bank, and we've had countless conversations about this, but being rejected because you're not willing to take risk and basically support the financial system by loaning out money and wanting to be fully backed simply by treasuries, I don't get it. I just don't understand.
Yeah.
So, I mean, maybe one day we'll see those with this new regulatory regime. Maybe it's going to change now, but I have my doubts. I just don't think that they want those. But stablecoins do still seem to be the killer use case right now for crypto. And as far as regulation, by far the lowest hanging fruit, right? I mean, we're going to get some sort of stablecoin regulation, I would bet, in the next 4 to 6 months. Hopefully it'll be sensible. Will that affect your business meaningfully?
I think that having more legitimacy in the stablecoin market will be helpful for trying to get institutions to actually use tokenized treasuries, because a big part of the benefit of tokenized treasuries, at least as they exist today, is 24/7 liquidity in and out of stablecoins, which themselves are already very liquid for folks who are able to touch them. But institutions generally aren't able to touch stablecoins, so they don't care about that benefit. So yeah, I think if and when institutions are able to touch stablecoins, then all of a sudden they're going to start caring about that quite a lot
It seems
more.
like these institutions that have trouble settling on weekends or doing business would love stablecoins even for that simple purpose. I mean, I think Stripe has to some degree integrated USDC to do those basically transactions on the weekends when the banks are closed. And it's very obvious. 24/7, 365 for settlement should appeal to every institution.
Yeah, absolutely.
So as you continue to build out these new products and look at new markets, I kind of asked you what comes next that you think will be popular. Do you think that we actually see these tokenized products start to replace the traditional rails that we have? Like a lot of people, for example, point at T+1, T+2, T+0, settlement in the stock market and the clearing houses and say, hey, if I tokenize that same Tesla stock, you buy it from me, I send it to you, you send me a stable coin, we're done here. What's going on? Do we ever get to the point where that is the standard, or is there not that much demand for tokenized individual securities? Is that not how people are going to trade? It seems like a no-brainer that the world would at least move in that direction.
Yeah, I think so. I mean, look, we're racing to get global markets out. We're, in deep partnership conversations with a bunch of crypto exchanges and wallets, and it seems like they're all extremely eager to offer equities to their users. So we've been very B2B to C focused, working with these sorts of partners to get the product out there. We'll learn a lot over the next 6 months, once, that goes live and we get some data about what the demand is. And I'm certainly excited to get that data. I think that the early users are not ones that have great access today. So I don't think that we're competing with traditional settlement infrastructure right now. You actually can think of a lot of what we're doing as like building almost a layer 2 settlement network for these sorts of public securities that is on top of and compatible with the existing security settlement infrastructure, right? I mean, public securities in the US are all ultimately held, public equities at the DTC, the Depository Trust Company, which is a subsidiary of the DTCC. And, that's still the case for all the securities that are going to be backing the tokens that we'll be issuing. It's just that, holders of our tokens can settle between each other 24/7, 365 on, as you said it, on a real-time gross settlement basis. They don't have to wait T+0, T+1, T+2. All of crypto, for the most part, has been done on a real-time gross settlement basis. And I do think there is like a little bit too much disdain that a lot of the crypto industry has towards this idea of delayed settlement. I think that we're heading in a direction in all of finance towards shorter and shorter settlement windows. But there is a certain amount of, sort of grease to the system that having short settlement delays allows. And we feel these pains even in crypto. I mean, particularly when you start thinking about distributing assets in a multi-chain environment, when it takes, seconds to minutes to move assets between different chains. If you're having to like pre-fund everything, now you need like liquidity pools, like giant liquidity pools and stable coins sitting on all these chains, that you're not earning interest on, just so that you can, enable certain transactions where, if you had, effectively like a cross-chain clearinghouse that, extended, even 5-10 minutes, an hour of credit to participants, a lot of these things would be much more capital efficient. I'm using this example because it's sort of something we were addressing recently in the context of, cross-chain instant minting and redemption for our tokens. But, delayed settlement also allows for netting, right? Like there's something like, 99.9%, reduction in, the amount of trades that actually take place to what's settled. Cause, if you trade with me and then I trade with someone else, and they sort of net out and you just settle to that someone else. I think finance will be done on very close to a real-time gross settlement basis, but with a little bit of an asterisk.
I mean, we're already seeing now, I believe it was NASDAQ that said that they were considering 24/7. I don't know if it was 24/7, but 7-day or 6-day trading. Clearly, crypto has put a bit of pressure on legacy markets to at least increase the time that they're open to allow more people to participate more hours of the day and more days of the week. So that's already an interesting nuance there. I don't think they'll get to 24/7, 365, but we're certainly pushing them closer.
Totally. Yeah. I mean, 24/5 to start, which we're seeing in more and more platforms. That goes, hand in glove with offering global accessibility, for markets that, might be sleeping during US market hours.
Interestingly, something just hit the tape as we're talking, which is that Circle to debut new global payments platform at NYC launch event. I guess this is announced today, but Circle's unveiling a new cross-border payments platform aimed at challenging legacy giants like Visa and MasterCard. So this obviously very much speaks to what we're talking about. And this is really interesting. I don't know if you saw this, but Circle also introduced a refund protocol for stablecoin transactions, offering built-in on-chain dispute resolution.
Okay.
That's interesting.
Yeah, they're going right after the card networks.
So this is a direct attack on Visa and MasterCard in America.
Yeah, sounds like it. And
That's
Visa and MasterCard are responding, right? I mean, they've been leaning very heavily into tokenization.
On-chain dispute resolution is really interesting because I think a lot of crypto natives would say once it's done, right? And see a lot of problems with rolling things back. But if you want to participate in the big pool, then, scams or even just wrong transactions, incorrect charges, chargebacks, which happen all the time with MasterCard and Visa, they have to be a part of it.
Yeah, absolutely. And, that's another thing that delayed settlement in general allows for, some window of time before, things are totally final.
What's the 10-year vision? So, maybe I asked 20 or 30, I don't know, but I'm pretty optimistic that between AI and, robots, that 10 years things are going to look very different. So I think we do have a pretty accelerated timeline in the world. What does 10 years look like for Ondo, for tokenization in general?
I think that DeFi gives us a great glimpse into the future. For those of us who were big power users of DeFi and, DeFi summer 2020, I think
were you farming tacos and yams?
Oh yeah. 4% an hour for yam. It's a great one. But, I always felt it was a very magical experience to have all of your financial assets just on your wallet. And in a single click, you can move from platform to platform. There's no lock-in whatsoever. Everything's interoperable and composable. I think that's the future that we're going to see, obviously with some guardrails and grown up a bit for all investable assets, right? I mean, today we have a total Frankenstein of different settlement systems by asset class and by region. And, when I was at Goldman, I worked at Goldman for a couple of years on the digital assets team before founding Ondo, and I would spend time just interviewing ops, and other back office folks about, why things are the way they are for settlement of different assets. And it's always just because that was the sort of simple fix for whatever the problem at the time was. There hasn't been a lot of very forward looking, particularly global design in a lot of these systems. And I think that, blockchains and tokenization represent a pretty disruptive and, fundamental upgrade to that system. One where all financial assets, whether it's, money or, a derivative or a security, are interoperable and really accessible on, a relatively level playing field to institutions and to retail. There's so many services right now that retail would love to have access to, like prime brokerage, where you can cross-collateralize, buy securities and crypto, and have best execution on a whole bunch of different venues that are just relatively expensive to provision, in part because of that Frankenstein nature of our existing clearing settlement systems. And I think that in, a world that looks more like, what we have in DeFi, but for traditional assets, the marginal cost of provisioning these sorts of services is just, next to nothing. And so retail can have, access to the same types of financial products and services as, the largest US hedge funds.
That's one of the most exciting parts, really, is that there's no longer the have and have nots, at least with access, when you really democratize this and open it up and decentralize it.
Absolutely.
That's where tokenization really, really becomes exciting, especially for the average person, especially for the average person that's not in the United States. It's funny, as we're talking, I always have kind of just a news feed spitting stuff. We obviously just had the story that I shared. And another one, Circle BitGo about to apply for bank charters. Others may follow. This is the Wall Street Journal today saying also that Coinbase and Paxos are exploring bank charters amid evolving U.S. stablecoin regulations. It's just amazing how fast this is moving, but that would allow them, at least in some restricted manner, to do lending and borrowing that we just described. Maybe it would look like what Anchorage somewhat has, but because I think they have some sort of banking charter. But this is interesting. I wonder if this is because they want to provide those services or because they have some inside baseball on the stablecoin laws that are coming that may state that stablecoin issuers are required to have a banking charter or a relationship with a bank.
Yeah, totally possible. It also just reduces their reliance on third-party banks, which they, of course, need for, minting and redemption purposes. But yeah, I think there's a huge uptick in the sort of convergence in competition between these kind of crypto native and more traditional players. I mean, earlier you were talking about Circle and Visa and MasterCard, Kraken offering equities and all the crypto exchanges offering equities, now competing against Robinhood, which is getting more and more into crypto and into tokenization. So I think that's just a sign of our industry growing up.
Are these competitors or are they future partners for an Ondo?
Both, right? There's always an element of both, I think.
That's interesting because, you're building similar products, but there's a lot of things that you'll probably be able to do for them that they can't necessarily do for themselves with the infrastructure that you're building.
Yeah, I think we're less competitive with a lot of those players because we are pretty B2B2C focused. Like just about all those players we mentioned have like their own end retail user bases. But to what degree are like Kraken and Robinhood competitors? Like, I don't know. I would think relatively high, but I'm not sure exactly.
Yeah, for sure. Is there anything that's happening at that legislative or regulatory level that concerns you right now? Obviously, we're all very excited that the massive sea change in how the industry is being approached. But I mean, listen, we're like inherently distrustful of government as people who have been in Bitcoin and crypto for a long time. And I have to imagine that even though we're getting legislation and regulation, that there could be some pitfalls or even unintended future consequences that they don't anticipate because it's so complicated.
Yeah, look, I mean, what we pay most attention to, is what's happening with the SEC. And I think everything's been great there so far. And, we're engaging on what we would like to see, in terms of sandboxes or, other guidance in the tokenized security space. On the stablecoin. Yeah. And I think in general, like for what we are trying to do at Ondo, we just don't think that we need a whole lot of new legislation, really just new, regulatory guidance or, further guidance. I'm not as concerned as I think a lot of folks in the industry are around like stablecoins maybe not being able to pay a yield. Cause like, as we talked about earlier, I think that can be addressed in a, securities law umbrella. I don't know the status of the like market structure stuff. I think that's coming a little bit later this year, but obviously that'll be important and, probably an even bigger unlock, for us to get some clarity on, what is and isn't a security.
How big do you think this market will become for the BlackRocks of the world and the Franklin Templetons and the Goldmans? I mean, do you think that this becomes a really meaningful part of their, earnings on any given year? Because it seems like they're definitely dipping their toes. I'm just wondering when they jump in.
Pure crypto or tokenized assets?
Yeah, tokenized assets, pure crypto, either one.
Yeah, I mean the line between tokenized assets and traditional finance is just going to become so blurry.
It's just going to become the underlying
gradually
tech.
over time that it's sort of hard to answer that one. On crypto, I mean, I think the Bitcoin ETF has already become fairly material. So yeah, it'll be interesting to see what the demand is like for all these other ETFs as we see them come to market. There seems to be a lot of interest in all these like MicroStrategy clones for all sorts of other tokens as well. So yeah, it'll be fun.
I'm
going
to go out on a limb and say I'm not sure that's going to go well.
Yeah, it's quite interesting.
Were you a Bitcoiner first? How did you actually find crypto on a personal level? Was it because you came into Yield Farm Yams, or were you here before that? Obviously, you were on the Goldman digital asset team. So,
yeah, I got into Bitcoin like most folks first, kind of late 2016.
Yeah,
nice. And then obviously followed by Ethereum and the ICO mania. Followed subsequently, and I think that was sort of the white paper stage of our industry. So I spent a lot of time, reading and dreaming about all these early decentralized applications, most of which have never really been built yet. DeFi is really, the one sector where we've seen a lot of things built and working. So, renewed my excitement in 2020 when I saw all of that, and, just doubled down since then.
What the hell is going on with Ethereum, man?
Yeah, it's kind of sad to see.
You still got BlackRock and other institutions are tokenizing funds on Ethereum. It's being used. It still has a ton of TVL. I can't make sense of the price. I mean, I get that there's an existential crisis.
Yeah, I mean, I think the relevance of it in real world assets is pretty limited. I mean, like we started there by default, because I grew up in, Ethereum DeFi. And then I think, BlackRock did the same, seeing we were there, and it's sort of pretty easy default. But the real world assets are so concentrated, it wouldn't take much for those assets to move elsewhere pretty quickly. So yeah.
Yikes. So the pain might not be over. Fun. Yeah, I mean, it really, I've been a pretty relentless Ethereum supporter over the years. I just thought that there was much ado about nothing, but it seems to be gaining traction, that maybe there's something happening here.
I think it is challenging to compete. I mean, sadly, it is challenging to compete as a chain without having slightly more, coordinated partnership, go-to-market, governance efforts.
They had it all, man.
I know that's very anti the, decentralized maxi ethos of crypto, but a lot of the use cases that we see are just not, around tokenization, as an example, are not ones where decentralization is, the core concern.
I mean, decentralization is important, but most Bitcoin maxis are also really excited about BlackRock having an ETF.
Yeah, whatever pumps the bags.
So there's always a little bit of cognitive dissonance. People cheer for the things that make their bags go up, even if they're maybe anti the original ethos of why they bought that asset.
Yeah.
Well, Nathan, man, I really appreciate the chat. I know that we're up to time. Where can people follow you, follow everything Ondo's doing, and participate?
Yeah, our website's ondo.finance. We're probably most active otherwise on Twitter at Ondo Finance, and yeah, I'm on Twitter as well at Nathan Allman.
Thank you so much, man. Always a pleasure to chat. Can't wait to have these conversations down the road as all of these things we're guessing at start to come to fruition, so that we can make more wild guesses at what will come after that.
Yeah, absolutely. Thanks for having me. It'd be great to be back on. Thanks, Scott.